Hey, what's up everybody? It's Moneymaker. Welcome back to the channel. Today, we're diving into the world of advanced trading indicators. You know how much I love breaking down complex topics to help you make smarter financial decisions, so get ready, because we're about to unlock some serious trading knowledge. These custom and derived indicators combine multiple data sources to give you a trading edge. We're talking about going beyond those basic indicators you see everywhere and stepping up to the pro-level tools that can seriously improve your trading game. So if you're ready to take your trading to the next level, buckle up, smash that like button, and let's get started. First up, we've got the Hull Moving Average, or HMA for short. Now, you've probably heard of the regular moving average. It's like the Toyota Camry of indicators, reliable but kind of basic. The HMA, on the other hand, is like the Ferrari of moving averages. It's designed for speed and precision. The HMA is all about smoothing out those price fluctuations and reducing lag. See, regular moving averages can be slow to react to price changes, which means you might miss out on potential trading opportunities. But the HMA uses a special formula that gives more weight to recent prices, so you get a quicker and more accurate picture of where the market is heading. Think of it like this. Imagine you're driving down a winding road. The regular moving average is like looking through your rearview mirror. It tells you where you've been, but not necessarily where you're going. The HMA is like looking through your windshield. It gives you a clear view of the road ahead, so you can anticipate those turns and stay ahead of the game. So, how do you use the HMA in your trading? It's simple. When the price crosses above the HMA, it's a bullish signal, suggesting a potential uptrend. Conversely, when the price crosses below the HMA, it's a bearish signal, indicating a potential downtrend. But remember, no indicator is perfect. It's always best to use the HMA in conjunction with other indicators and your own analysis to confirm your trading decisions. But trust me, once you start using the HMA, you'll wonder how you ever traded without it. Next up, we're diving into the fascinating world of the Guppy Multiple Moving Average, or GMMA. This indicator is like having X-ray vision into the market, allowing you to see the behavior of both short-term and long-term traders. See, the GMMA uses not one, not two, but 12 different moving averages to paint a comprehensive picture of market sentiment. These moving averages are divided into two groups, 6 representing short-term traders and 6 representing long-term traders. Think of it like this. The short-term traders are like the impatient day traders, constantly jumping in and out of positions, looking for quick profits. The long-term traders are like the cool and calculated investors, holding on to their positions for weeks, months, or even years. The GMMA plots these two groups of moving averages on your chart, creating two distinct bands. When the short-term band crosses above the long-term band, it signals that the bulls are in control and a potential uptrend is underway. Conversely, when the short-term band crosses below the long-term band, it indicates that the bears are in charge and a potential downtrend is looming. But here's where it gets really interesting. The spacing between the two bands can tell you a lot about the strength of the trend. A wide separation between the bands suggests strong momentum and a high probability of the trend continuing. A narrow separation, on the other hand, indicates weakening momentum and a potential trend reversal. The GMMA is a powerful tool that can help you understand the balance of power between buyers and sellers in the market. By analyzing the interactions between the short-term and long-term bands, you can make more informed trading decisions and potentially increase your profits. Now let's talk about the Directional Movement Index, or DMI. This indicator is like a compass for traders, helping you determine not only the direction of the trend, but also its strength. It's like having a secret weapon that tells you when to jump on board a trend and when to steer clear. The DMI consists of 3 lines, the DI+, the DI, and the ADX. Think of the DI+ and DI as two opposing forces battling it out. The DI+ represents buying pressure, while the DI represents selling pressure. When the DI+ is above the DI, it means buyers are in control and the trend is bullish. Conversely, when the DI is above the DI+, it suggests sellers are in charge and the trend is bearish. But here's where the ADX line comes in. The ADX measures the strength of the trend regardless of its direction. A high ADX reading above 25 indicates a strong trend, while a low ADX reading below 25 suggests a weak trend or a ranging market. So, how do you use the DMI effectively? It's all about looking for those sweet spots where the direction and strength of the trend align. For example, if the DI plus is above the DI and the ADX is above 25, it's a strong bullish signal. Conversely, if the DI is above the DI plus and the ADX is above 25, it's a strong bearish signal. But remember, like any good compass, the DMI works best when you use it in conjunction with other tools and indicators. Combine it with your own analysis, and you'll be well on your way to navigating the markets with confidence. Let's talk about the vortex indicator, an indicator that's all about identifying those early signs of a trend change, so you can get in on the action before everyone else. Imagine the market is like the ocean. Sometimes it's calm and predictable, other times it's turbulent and unpredictable. The vortex indicator is like a seasoned sailor, able to read the subtle shifts in the wind and waves to anticipate those big market moves. This indicator uses two oscillating lines, the VI plus and the VI, to measure the strength of bullish and bearish price movements. Think of these lines as two competing forces battling for dominance. When the VI plus crosses above the VI, it signals that bullish momentum is gaining strength and a potential uptrend is brewing. Conversely, when the VI crosses above the VI plus, it indicates that bearish momentum is taking hold and a potential downtrend is on the horizon. But the vortex indicator isn't just about identifying the direction of the trend, it's also about gauging its strength. The further apart the VI plus and VI lines are, the stronger the trend. The closer they are, the weaker the trend. So how do you use the vortex indicator to your advantage? Look for those moments when the lines cross, especially when they're accompanied by a widening gap between them. These are the telltale signs that a significant move is likely underway. By catching these early signals, you can potentially enter trades early and ride the wave of the trend for maximum profit. Finally, let's talk about the zigzag indicator, an indicator that helps you see the forest for the trees in the market. You see, the market can be a noisy place, full of distractions and false signals. The zigzag indicator is like a noise-canceling headset, filtering out those minor price fluctuations and revealing the true underlying trend. Think of it like this. Imagine you're trying to draw a trend line on a chart that's bouncing all over the place. It's tough, right? The zigzag indicator simplifies things by connecting the significant price swings, ignoring those small, insignificant movements. This creates a clean and easy-to-read chart that clearly shows you the major peaks and troughs of the market. Now, the key to using the zigzag indicator effectively is to adjust the percentage setting to match the volatility of the market you're trading. A higher percentage setting will filter out more noise, which is ideal for volatile markets. A lower percentage setting will be more sensitive to price movements, making it suitable for calmer markets. So how do you use the zigzag indicator to your advantage? It's all about identifying those key support and resistance levels. The peaks formed by the zigzag lines often act as resistance, while the troughs often act as support. By trading these levels, you can potentially increase your win rate and maximize your profits. And there you have it, folks. 5 advanced indicators to enhance your trading strategy. Remember, these are just tools and it's up to you to learn how to use them effectively. Don't be afraid to experiment, backtest your strategies, and most importantly, never stop learning. Don't forget to like, subscribe, and hit the bell icon for more trading tips and insights. And as always, I'm here to help you achieve your financial goals. Happy trading!